if you start to look at more specific things like Bitcoin, this is looking at the correlation between Bitcoin and global liquidity weekly. It's possible it may even fall, and therefore the prospective gains in Bitcoin are not going to be there. However, and this is the however, which is always very difficult to time, on setbacks, I'd be a buyer. And, I think the trend in both gold and Bitcoin is really well established. There are two things to bear in mind when you look at this. Number one, the long-term ratio between Bitcoin and gold seems to be about 28 times, okay? And that's, that may be a trading rule, but it's not a bad long-term rule, okay, to think about, okay? So you could be, easily thinking of huge inflation in Bitcoin prices over the long term.
A quiet monetary shift is taking place beneath the surface of global finance. China, following a trajectory like Japan but about a decade behind, is deliberately weakening the nominal value of the yuan to reduce the real burden of its debt, especially in the property sector. Michael Howell, global liquidity analyst, argues that the meaningful benchmark isn't the yuan-dollar exchange rate, but the yuan's value against gold. Beijing's steady gold accumulation is deliberate. As the currency devalues, gold strengthens the financial system and provides a cushion against instability. According to Howell, this sets up a world with two competing monetary subsystems. The United States is building a dollar structure backed by Treasuries, increasingly wrapped inside digital assets like stablecoins, essentially a system with digital collateral. China, by contrast, is moving toward a yuan underpinned by gold. In that environment, both Bitcoin and gold become strategic hedges rather than rival assets. The takeaway, he says, is not to choose one or the other, but to hold both. This competition will produce financial conflict. China has incentives to undermine confidence in digital assets through cyber disruption, blockchain attacks, or advances in quantum computing because shaking trust in digital systems weakens the dollar's new architecture. The U.S., meanwhile, benefits from holding gold prices down to limit China's leverage. Howell is clear on one final point: neither country will return to a rigid gold or Bitcoin standard. Great powers need monetary flexibility to finance governments, especially in crisis or war. So, while gold and Bitcoin may trend higher in a fiat world, he expects sharp volatility as the US and China battle for monetary influence. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Look at China, the orange line. China is about 10, 15 years behind Japan. And what it's trying to do now is exactly the same thing. So what you're seeing is the Chinese yuan devaluing. But as I've said before, don't necessarily look at the yuan US dollar cross as your marker here, your benchmark. Think about the yuan gold price. And I've tried to show this in this chart, which is always out of date because the line moves up and down so dramatically. But this is really trying to show what the Chinese have been doing. And it's no mistake that the Chinese are actually buying gold as well, because it's simultaneously shoring up their financial system and giving them some cushion against this devaluation. But what they're doing is they're trying to reduce rather the nominal value or nominal impact of Chinese debt, particularly real estate debt. So what you've got to do is to devalue your paper assets, i.e. the yuan, against real assets, i.e. real estate or gold, and that's what they're successfully doing. And that is basically the background to the Chinese monetary system. And what you've got basically going on in the world economy, big picture, is you've got a bifurcation of the world monetary system into two, if you like, subsystems. One is a US system that is backed by treasuries, but those treasuries are wrapped in stablecoin, okay? So effectively, it's a digital collateral, if you like. And then what you've got in China is a paper yuan system that is increasingly backed by gold, and therefore you've got a gold-backed or quasi-gold-backed system in China. So you've got two ultimate collaterals. You might say digital assets for America, read Bitcoin, and gold in China. And therefore we've got to start thinking seriously about diversifying into those two assets, not as alternatives, but as complements. you want gold and you want Bitcoin. You don't want one or the other. And that's really the story. China wants its capital to be in control. America wants its capital to be in control. And that is really, if you like, the vent is currency, or you can think of it in currency terms, I should say. So if you want to undermine the US dollar with its digital collateral, what China's got to do is to try and undermine the integrity of a digital coin. And that may be attacking a blockchain system, or it may be, it may be trying to do cyber threats, whatever, because the more disruptive you are in digital technology, the less comfortable people may be holding these digital assets. So, the advent of quantum computing and the advances China is making in that sphere are probably ultimately a threat to the dollar based monetary system looking into the future. Equally, America will then think, well, okay, it's in our interest if China is backing things with gold, or it's got a lot of gold. We don't want the gold price to go up because it's giving China more power. So what they really want to do is to, if you like, stabilize or reduce the gold price. So what I'm saying is, I don't know who's going to win this battle, but you're likely to get a lot of volatility on both those two asset classes. They may trend higher in the long term. They should do, because we're in a fiat world, and those are basically collateral hedges. But you're going to get volatility between these two areas, as sometimes the US is in control and sometimes China's in control. But the one thing that you won't get, I absolutely guarantee, is a return to a gold standard. And some people are arguing that this move by China to accumulate gold is a return to a gold standard. It definitely is not. It may be giving the sort of a connection to gold, but they can't go back to a gold standard, because it would tie the hands of the monetary authorities in terms of financing the government. A great power such as China or America simply cannot afford to go back to a rigid monetary or digital standard. You simply can't do it. You couldn't fix the dollar to Bitcoin in the same way as you couldn't fix the yuan to gold. It would be impossible, because you'd lack, if you like, the ability to change fiscal policy. And that's what they need to do, particularly if we're in ever get to the stage of being in a kinetic war.
Michael Howell highlights the trajectory of global liquidity and its impact on markets in the coming years. According to his analysis, while liquidity growth shows short-term momentum, projections for 2026 suggest a slowdown, which could dampen potential gains in assets like Bitcoin. He emphasizes that even if liquidity flattens or declines, the long-term trends for gold and Bitcoin remain strong due to ongoing monetary inflation. Howell advises investors to focus on buying these assets during temporary setbacks, as they serve as reliable hedges in an inflationary environment. Looking further ahead, Howell examines the structural deficit in the U.S., which the Congressional Budget Office projects to reach 10 to 12% of GDP annually by 2050, with public debt ballooning to roughly 250% of GDP. By modeling the gold value required to match this debt growth, he estimates gold could reach $10,000 by the mid-2030s and potentially $25,000 by 2050. He also notes the historical precedent. Over the last 25 years, U.S. federal debt increased tenfold, while the S&P rose fivefold and gold rose 13-fold. Howell concludes that in a fiat world, holding inflation hedges like gold and Bitcoin is essential for preserving generational wealth. Let's get back to the interview.
I think I mean, if you look at this chart here, which is looking at global liquidity and world wealth, this is annual changes. The orange line is the global liquidity growth. Now, what I've done is project that over the next few months. But if you look more into 2026, that dotted line is going to come down. It's got a little bit of momentum near term, but you kind of get the idea that the black line will follow that. So I'm not saying, completely bail out of markets right now, but I think you've got to start thinking about 2026 being a less attractive year for sure. And if you start to look at more specific things like Bitcoin, this is looking at the correlation between Bitcoin and global liquidity weekly. Now, I showed earlier on a chart showing Fed liquidity and the S&P, which was about a 6-month lead time. This one is shorter between global liquidity and Bitcoin of about 13 weeks. But what it's saying is that, the black line is looking at liquidity. This is a very short-term indicator, but we would suspect that black line is going to start to flatline more and more over the course of 2026. it's possible it may even fall, and therefore the prospective gains in Bitcoin are not going to be there. However, and this is the however, which is always very difficult to time, on setbacks, I'd be a buyer. And, I think the trend in both gold and Bitcoin is really well established. I think you've got strong, compelling trends there because we're in a world of monetary inflation. And therefore, what you've got to do is to buy these things on dips. And a sort of a final comment is if you really want to look at the long-term prospects, start to look, I'm going to show you an earlier chart. This chart is looking at the structural deficit in the US economy. Now, the structural deficit, the orange line, is shown as a percent of GDP. And that is basically careering towards levels of 10 to 12% of GDP each year by 2050. These are not our figures. They come from the Congressional Budget Office, which is a bipartisan body in the US. The only change we've made to those figures is we've put a slightly elevated number for defense spending at 5% of GDP because that's the NATO target. But otherwise, we take their numbers. And what you can see is the structural deficit, which is 4 items: Social Security spending, Medicare, the interest bill, and defense. No discretionary spending at all. That's what you get on the fiscal deficit. The dotted line is debt held by the public, which you can see on that right scale, balloons up to 250% of GDP by 2050. Now, the Congressional Budget Office has a similar projection of a very similar figure. So our numbers are not out of line. What does that mean? Well, this chart is saying, look, let's just make an assumption here. And let's make an assumption that the gold value of US government debt does not change from now until 2050. What would the gold price have to be to match that increase in debt? And what you see there is the implied gold price. Now, that means that gold hits 10,000 by the mid-2030s and prospectively could get to $25,000 an ounce by 2050, okay? There are 2 things to bear in mind when you look at this. Number one, the long-term ratio between Bitcoin and gold seems to be about 28 times, okay? And that's, that may be a trading rule, but it's not a bad long-term rule, okay, to think about, okay? So you could be, easily thinking of huge inflation in Bitcoin prices over the long term. The second thing to say is that if people think this is fanciful, think what happened in the last 25 years. The stock of US debt went up 10 times, right? From year 2000 to year 2025, a 10-fold increase in federal government debt. That's eye-watering. The S&P over that same time frame went up barely 5 times. Gold prices have gone up 13 times. So gold has more than matched the increase in federal debt. And we're just saying, let's assume it matches the increase in federal debt. So that is where the long-term future is. You've got to have monetary inflation hedges because we're in a fiat world. And we're in a fiat world until we're not, but at the moment we're in a fiat world. And to get out of a fiat world, you'd have to have really huge austerity from governments and no prospect of heightened military tensions. I don't think we've got either.
Bitcoin serves as a strategic hedge in an increasingly complex global monetary landscape. As major powers diverge, China leaning on gold-backed stability and the US building a digital asset-oriented system, Bitcoin emerges alongside gold as a complementary store of value rather than a competing asset. Its short-term performance is closely linked to global liquidity, which is projected to slow in the coming years, creating periods of volatility and short-term uncertainty. However, these fluctuations do not undermine its long-term trend, which is supported by persistent monetary inflation, rising government debt, and structural deficits in major economies. Over decades, Bitcoin has the potential to act as a powerful tool for wealth preservation and portfolio diversification, providing protection against the erosion of fiat currencies while serving as a hedge in a world increasingly defined by geopolitical financial competition and evolving monetary systems. How might Bitcoin's role as a hedge evolve as global monetary systems diverge between gold-backed currencies and digital asset-oriented frameworks? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support and we hope you enjoy the video.